And you mentioned diversification. Where are you sort of looking at this point in time in particular?
So I would say that across developed market, Japan is still our top pick, just because there are really regime shifts happening in Japan. The economy does stand to benefit from those technology shifts that we're seeing, such as artificial intelligence. They have an aging population. Hopefully, these are things that these technologies can come in to help Japan solve these structural challenges. And of course, we think inflation is real. It will help to lift asset valuation in Japan market. So, given these longer-term outlook, and even though Japan's had a really good run last 2 years, we still think that it's in a bull market. It has room to catch up. So that is our favorite play within developed market. And we'll also look maybe a little bit to Europe. And I think China still looks a little bit more interesting now, even though the macro economy still looks pessimistic. Market seems to be bottoming. So there are all these opportunities that we're looking at the moment in terms of diversification away from the U.S. equity market at this point.
And so when it comes to Japan in particular, a weak yen has been one of the sort of big factors behind the rise of stock markets as supportive of a lot of exporters. But the question right now as well is just that level that we're seeing today around 154 against the dollar. We do have a question of the day as well relating to the currency. So Japan intervening at 160 or before that point, do you have any sort of views on yen intervention?
I do think that it depends on the manner at which we get to 160. If it happens in a very rapid and somewhat disorderly way, then I think FX intervention certainly is a risk. It does, I think, we have to go back to the overall framework for the Japanese yen. It is facing those structural depreciation pressures because of things that are more global in nature. So, for example, the interest rate differential between Japan and the U.S. And also, don't forget, Japan actually runs a trade deficit now. So, for all these structural reasons, and of course we have the uncertainty in the global economy at this point, given geopolitics. All of these things could even exacerbate yen weakness. So, I think that these are the reasons why yen is at the level that it is, and that's why I think FX intervention should not be ruled out. But I think policymakers will not try to reverse the trend. I think their goal is to smooth the process through which we get to these levels.
Julia, when you take a look at Korea and how it's in a lot of ways trying to replicate the governance success that we've seen for reforms in Japan, do you think that is potentially a good longer-term play?
So there are opportunities that we like in the Korea market. I think we like the semiconductor supply chain story. We actually do think Korea is a bit of a laggard in that regard, partly because it's more cyclical aspect of the semiconductor supply chain. But we do think that it is bottoming out if you look at some of the leading indicators. So we do like the Korea market. I do think that Japan is somewhat different in the sense that it is seeing a structural shift from deflation to reflation. So it probably has a little bit more valuation re-rating potential compared with Korea, which is really in the same macro regime as they were a couple of years ago. But certainly from a tactical perspective, we have been more positive on Korea as well lately, just because of the semiconductor story.
And in terms of structural shifts, perhaps less favorable in the direction that China is heading in. But do you see any selective opportunities as we see potentially a stabilization, at least from these latest numbers?
Yeah, I think China market is quite interesting. The macro economy continues to face challenges. With the housing market, you don't have to look very far. Sales are still falling. There's no stimulus, but it looks like the market has found the bottom. I think partly because it does look like valuation is quite cheap, and it's a good level of support. And if we look further out, if the housing market does not become a big drag on the economy economy for financial stability reasons, then over time, the manufacturing sector could overtake it as a bigger driver of growth. And that's, of course, what the policymakers are saying at the moment. But we're also seeing some of that play out in the data. If you look at manufacturing sector in production or investment, they do seem to be fairly resilient and maybe a little bit more than market had expected. So I think that is maybe a theme to really watch for the medium term. And I think that, at this level, it seems like there are themes that you can pick in a China market. We do prefer to barbell a little bit. So we do like, technology. We also like some of the select names in those new manufacturing sectors, be it EV or battery. Not all of them, but the select names, and barbelling that with high dividend for a more defensive posture. So that is the strategy that we have at the moment.